What's up, traders? Welcome back to the 2G's trading channel, and in today's video we're gonna dive straight into the ultimate beginner's guide to trading, investing, everything trading related. None of the unnecessary jargon and fluff, just straight up actionable insights to get you guys confident to tackle these markets. So let's begin. First up, what is trading? So trading is the art of buying and selling, the movement of assets and the movement of price to make a profit. There's a difference between trading CFDs, there's a difference between trading stocks, and there's a difference between trading cryptocurrencies. So we're going to firstly look at the various different markets that you can potentially trade and invest into. Also remember, trading is a skill, it is not a lottery ticket, so be patient with yourself. If you think about lawyers, doctors, engineers, any professional career, these guys study years and years and then also work their way up the corporate ladder to get their earning capacity as high as it is. So don't pressure yourself into thinking 3 months, 6 months, even 12 months down the line of your trading that you are going to be making big bags of money. Be patient. This is a career. This is a journey. And if you're patient with yourself, you might reap the rewards. So first up, I'm going to talk about stocks. Most of the traders, most of the people out there know about buying stocks and selling stocks. But buying stocks, in essence, is buying a piece of a publicly listed company and you become a public shareholder of that stock. So in this example, let's say you bought some Amazon stock, and let's use an arbitrary number of the stock was trading at $100. You bought one stock at $100, price then went up to $110 and you sold out. That is a 10% gain or a $10 gain on your stock. But with stocks, it is only a buy model. So in terms of owning the actual physical stock, you can only make money when the stock goes up and when you sell out. Some of these companies actually pay dividends either annually, biannually, or even quarterly. And in that regard, you can actually earn dividends from the income produced by the companies. These stocks that has got a very good dividend yield, they produce cash flow, and you don't necessarily need to sell out of the stock to make money from it. Next up, Forex. Obviously, Forex has got a terrible reputation across the world with guys selling lifestyles, selling the courses, selling signals, even trading robots. But effectively, Forex trading is purely trading strength between two currencies. It's usually either a major currency crossed with a minor currency, or it could even be two major currencies in the case of Euro USD. So when you see the price of Euro USD, and let's say for instance in this case, Euro USD is trading at 1.2. That effectively means that you need $1.2 to buy 1 euro. Then third on the list, cryptocurrency. Some of you may have traded cryptocurrency. Some of you have maybe just been watching from the side. Crypto is also a widely adopted trading asset. And for some, it's a scary thing because it is quite volatile. And for some, it is an opportunity to maybe try and make a quick buck. But cryptocurrency is a decentralized currency that you can trade over certain exchanges, even with certain banks that have it. But cryptocurrency also definitely one that you will see a lot of your mates, people around you trade, and they don't maybe talk about it. It's like that unforgivable sin that if you bring it up in a conversation and your portfolio is down, people are going to throw some shots at you. Commodities, that is also a widely adopted one, especially if you look at gold in recent months and years. Commodities, basically you get your soft commodities, you get your hard commodities, but this is all to do with commodities. Gold, wheat, flour, corn, any commodity you can almost think of is somewhere listed and you can trade it. Oil, all of those commodities. But I think as of late, gold has skyrocketed in terms of popularity because it's become so volatile with everything that's going on. So you could also look into trading commodities. Then another one of my favorites is indices, and you would have maybe seen people talking about Dow Jones, Nasdaq, S&P 500, the FTSE, the DAX, but indices are basically all of the major countries' stocks compiled into a index fund. So for instance, the Dow Jones Industrial Average, that basically is the top 30 biggest stocks in the United States and the index price of that. Nasdaq, for instance, top 100 listed tech companies in the USA, and especially here in South Africa and especially in the Western world, indices has become very popular to trade, especially futures. So that is also potentially one for you to look at, trading indices. Now coming back to it, you need to find your fit. And we spoke about quite a few markets that you can trade, but at the end of the day, you need to think about what is going to fit in with your lifestyle, what is going to suit your personality. If you are somebody that's very risk averse, for instance, you would not be trading something that is as highly volatile as the crypto market. That is not going to suit you. It is going to be completely against your inherent bias against avoiding danger, and you would maybe want to look at trading stocks, something that's a little bit more slow paced. It's not as fast as cryptocurrency, and that's going to give you the opportunity to get into your stock positions and let it do its thing. At the end of the day, if you think about stocks, there's a very good saying that it's not about timing the market, but it's about time in the market. And a lot of times you have to let time do the heavy lifting for you. So I'm going to talk about a few different trading styles, and for the most part, the one that everyone has heard of is day trading. And day trading is purely a case of where you open and close a trade within the same day. It's not investing, it's not swing trading. You are purely capitalizing on moves on the day. Secondly, one that is sometimes tough for some guys to do is swing trading. And swing trading is a case of where you buy at a certain level and you could be holding that position for days, weeks, even potentially months for a much bigger price swing. So for some guys, swing trading, especially if you've got a 9-to-5, swing trading could be more suited to you. But if you have got some free time in between, day trading could also be better suited to you. Scalping, maybe one that is not suggested for new traders, especially newbies. That is where you actually capitalize on very small incremental moves in the market using quite big and large position sizing. So for instance, you would be in and out of a position within seconds, not even minutes. I'm talking about seconds, and that is scalping for you. So if that is something you need to look into, give yourself the time. It's not going to be in your first week, maybe not even in your first year, but later on you can potentially adopt the skill. And then last but not least, we've got position trading, and position trading is effectively almost likened to investing, where you hold a position for months, even potentially years, and you build a position in a instrument or in a stock, and you do not get out of that position within a week or 2 weeks. We're talking about months, even potentially years. So you choose your poison and you stick with it. Now getting into the good stuff, technical analysis versus fundamental analysis. So this is now where you're going to get into the real art of trading. And the first one we're going to look at is technical analysis. You might have seen some charts. You might have thought, what is this guy looking at? It almost looks like an ECG, somebody's heart rate, but that is actually just a simple price chart. And part of being a trader is analyzing these charts to potentially find correlations, to potentially find points of control where you will be executing your trades from. So we're gonna jump straight into the technical analysis front, and I'm actually gonna demo, and we're gonna go straight over to my chart where we will be discussing more of the technical analysis side of trading. All right, guys, now we're gonna jump straight into some technical analysis, and I'm on a chart here, and one of the first things that we need to discuss is candlesticks. You might have heard about it, you might have seen some of it, but I'm going to explain to you what a candle is and how we use it. All right, so I just draw two candles here, a bearish candle, which is the red one, and a bullish candle, which is the green one. Very simply put, if you think about a bear, it attacks from the top down, and if you think about a bull, it attacks from the bottom up. So a bearish candle is a candle that opens up and closes lower, and a bullish candle is a candle that opens up and closes higher. Very, very simple. This candle right here, let's look at the bearish one. That is where the candle opened up. It created a high, which is usually some type of wick. These wicks can be long, these wicks can be short, but that is what we call a candle wick. So if I had to draw a line diagram of this candle opened up right there. Somewhere during this time period, it created a high. It then proceeded to create a low, and that is where the candle closed. All right. Now you may ask, Chris, what are you talking about? A candle that closed? When will a candle open? When will a candle close? So for the most part, if you look in my text box there and I drop down to a chart, this candle, basically every candle you see on this screen is a 5-minute candle. So every start of the 5-minute and every close of a 5-minute, a candle will print. So in my toolbar here on the right, you can see that we have 33 seconds left. Then this 5-minute candle will close. All right, so if I go down to an hourly time frame or go up to an hourly time frame, you'll see that there's 55 minutes left on this candle, and every single candle you see on the chart here is basically 60 minutes worth of price printed into a candle. Okay, so these candles have printed, and the one you currently see on screen is still currently being formed. And as you can see, as we discussed, this candle opened up there. That's the body of the candle. It created a little bottom wick, and now it is pushing towards the upside. So in 54 minutes, this candle will close, and we will have a look at where it is going to close. So very important for you to understand the concept of candles, how they are formed, and what you are looking at. All right, we're going to talk a little bit about candle formations a little bit later on in this video, but I just want you to understand what a candle is in order for you to know what you are looking at on the chart. Also, what I want to talk about is that higher time frame candles, and when we say higher time frame, for instance, a 4-hour candle and 4-hour market structure has got a lot more significance than, let's say, for instance, a 1-minute candle, because all of these candles only took 1 minute to form. All right, so that's going to be important a little bit later in this video. Then another concept I want to talk about in technical analysis is something that we call market structure. It's something that you're going to hear quite a bit. And if you think about the bearish candle and the bullish candle, you also have bullish market structure and bearish market structure. So what is bullish market structure? Bullish market structure is when price proceeds to create new highs and higher lows. So let's make this green that you guys can see what I am talking about. So bullish order flow or bullish market structure is when the market proceeds to create new highs on the market, depending on what your time frame is. and then also it is creating higher lows. So you can see all of these lows are getting higher and higher, and we are taking out the highs. So this is bullish market structure, very simple to think about. Now going on to the next one, as much as we've got bullish market structure, we also have bearish market structure. And you guessed right, bearish market structure is just the opposite of bullish market structure. And I'm actually going to make this red as well for you to start thinking about. Bullish is green, bearish is red. And now the opposite is true, where the lows are getting lower and the highs are also getting lower. So this is bearish market structure, and I hope you guys understand this. For some of you, this will be completely new, but take some time to look at this, maybe even print screen this. But this is bullish order flow, this is bearish order flow. Now I quickly want to talk a little bit about support and resistance. This is most probably the most fundamental key or aspect to technical analysis, is support and resistance. So as the word says, what is support? I'm going to draw two zones here. We're going to do this on a chart very soon, but I'm going to draw two zones here for you, and I want you to think about the following. So a support zone, very simply put, is an area that if price gets into that zone, we expect price to be supported. All right, we expect price to hold that zone and actually start to push away. All right, so in this case, that green zone is an area of support where we expect price to hold. So let me just type that in for us. That is our support zone, and we expect price to hold. Secondly, a resistance zone is an area where we expect price to resist from. All right, so this is an area where we expect that if price starts to reach that level, that price will fail to get through that zone and actually reject, and that zone starts to act as a resistance level. All right, so support and resistance is something that you're going to be using all across your trading, investing, crypto, wherever it is adopted across all asset classes. Now, taking this, putting it into the chart and looking at some levels, I'm going to mark up a chart for you and to show you a little bit about support and resistance. Okay, so we are now on the hourly time frame, and how do we draw support and resistance areas? Think about it very simply put, it's an area where a lot of reaction has happened. So just straight off, looking at this chart, the first area that my eye picks up is that this is a potential support or resistance zone. Okay, I'm going to make this a neutral color so that you don't think it's a resistance, because remember, also in trading, broken support becomes future resistance. What do I mean by that? I'm quickly going to come back to this side of the chart, because this is also very important for you to understand. So let's say this is that support area we looked at earlier, and price did not hold as support. We actually broke through it. Then this support level becomes a potential future resistance level for price to continue lower. The same holds true with a resistance zone. If I zoom in here a little bit and we look at a resistance, price did not hold as resistance but actually got broken through. Then the idea is that if we come back here and we hold that level, that becomes a future support now. So in the past, it acted as a resistance, and now it is acting as a support. All right, so jumping straight back into the chart, this is that first area that I want to start looking at. And you can say, Chris, why do I say this is a support or resistance level? Now, first and foremost, looking at the chart, you can see a massive reaction off that level once price started to try and push into that level. Then secondly, we saw another nice reaction there with a rejection wick to the upside. And then also here we saw a little bit of an overshoot, but effectively price rejecting that zone. Here you can also see for 4 hours, remember this is a 1 hour time frame, so for 4 hours price tried to get into that zone, and then on the 5th hour it actually rejected and came all the way down. And now again you can see there a nice little bit of reaction, and then earlier this morning around about 3 o'clock GMT plus 2, we had a nice reaction off that level as well. So that is the first zone that I'm going to mark out for us. And then secondly, a zone that I also want to mark out for us are these session highs. This was Thursday's high, and this becomes a critical resistance level. Now you can say, Chris, but that is only one zone. How can that be a resistance? Very simple. If you think about it, on Thursday, that was yesterday, price rejected that zone and price made a daily high and traded all the way back down. So that is a very key fundamental level, because if we start to trade into that level today, think about it. Yesterday, the buyers gave up on that level. Now today, that's either going to be the same case on a Friday. Once we hit that level, buyers are going to throw the towel in again and the sellers are going to enter, or what's going to happen is the buyers are going to push it through. And what did we talk about previously? Past resistance potentially becomes future support, and that is something that could happen here today. So I'm going to keep this on the chart for us, and then I'm quickly going to mark up the rest of the chart for us. Then also scrolling down a bit, I can see a very nice zone here where price was supported, and now we've got two very good zones for us to look at on the hourly. So now we can say, all right, if price comes back down here, there is a very high potential for us to find some support. Okay, price can potentially do something like this, but we are also ready for the idea that this level could be broken down. Again, a little key that I'm going to give you that the textbooks tell you, which is completely wrong, is that the more times a level is tested, the stronger it becomes. That is so far from the truth. The more times a level gets tested, the weaker it becomes. So now, with that being said, if we ever come back down to this level, I would actually expect price to potentially break through this level and become a resistance to continue down. All right. Now, I'm going to do one more section on this chart. Looking left here with me. Again, another nice level where there was quite a bit of reaction, and now we've got a very nice marked up chart, and we've got a few zones here. There's no right or wrong with support or resistance. This is something that comes with experience and time in the market, and this is something that you're going to have to practice, forward test, back test, to really get yourself familiar. So I'm going to say that on the hourly, I'm actually working with 3 zones. So that is going to be my zone 1, this is going to be my zone 2, and that is going to be my zone 3. Another thing with support and resistance, all that we're expecting is for price to trade within the zones. It is very, very simple. So the idea here would be in zone 1 is that if price holds onto zone 1 here, it might push to the highs here. All right, very simply put. But the idea also is that if we start breaking into zone 2, let's say a little bit later, the idea is that we will fill out this range in zone 2. So a lot of times, if you've joined our live streams, you would hear me talk about a trading range. And for me currently, looking at NASDAQ here, this is the NASDAQ chart, we are currently within this hourly range. So I would expect if price holds this bullish order flow that we're currently seeing, I would expect price a little bit later today to fill out this range. All right. So for the most part, this is where traders tend to struggle and tend to overcomplicate their trading, but effectively trading is a game of probabilities. And I'm just going to give you a simple scenario that I've actually drawn out with our Project G members, and I hope this is going to make a lot of sense to you. So in this scenario, let's say these are hypothetical support and resistance levels looking to the left, and now we've got price starting to trade. Okay, so the idea is very simple. If price is holding this level of support, where do we think it will go to next? Price will then seek out the next resistance level. All right, from this level, price can either reject to come back down in the range again, or price can actually break out to potentially continue up. All right, so a breakout like this is not confirmed up until we've got a retest on it. So those are why these entries are sometimes a little bit riskier, because you do not know whether price will continue out of this range. All right, so for that reason, a lot of times it's better to wait for that resistance break to retest and actually show you that it's holding. Okay, so there's two scenarios. I always say it: at a resistance level or at a support, only two things can really happen. A resistance level can either be broken to the upside, or it's going to act as a resistance and price will reject. But here's the thing, this is where a lot of the, let's say a lot of the theories out there, ICT, SMC, all of these theories come in with the following, is that if price breaks out and for some reason does not hold outside of the zone but closes back into the zone, this is what we consider a failed breakout. All right, guys, it is very simple. It's a failed breakout. You're going to start hearing a lot about fake outs, but for me personally, all this is showing is that the bulls did not have enough momentum to carry price through that resistance. It got the buyers very excited, everyone thinking we are going higher, and then it closes back into the range. And what have we said? From a resistance, we will seek out a support. From a support, we will seek out a resistance. So in theory, we would now expect price to continue down lower, or even maybe come back to test that zone and then continue lower. Same thing here. You can have a scenario like this. Again, that is a failed breakout to the downside. Now all of a sudden price couldn't hold below and it trades back into the range. And where can price go to now? It will seek out that resistance. But let's say, for instance, we had that breakout and we had price holding as resistance there. You would expect price to fill out the next range. So that's why I always say with trading, we are effectively just trading ranges. All right, so we're trying to figure out, is price breaking support? Is it going to go from the one support to the next resistance? Will it break resistance or will it hold as resistance? But effectively, this is all that price is ever going to do. All right, now coming back to it, I want to talk a little bit about, let me just delete this for us. I want to talk a little bit about potential price structures that you can trade on a daily basis. We spoke about support and resistance. What we've not talked about a lot is a previous daily high or a previous daily low. So for the most part, as a new trader, to keep things very, very simple for you, I would suggest that on a daily time frame, and I'm talking about the daily candle of the previous day. So let's say today it's Tuesday today. Let's say this was Monday's daily candle close. It was bullish. I would then suggest to a new trader, and again, this is not financial advice, this is purely education and entertainment for you guys, but I would suggest that using that previous daily candle structure in terms of being bullish and using it today also as bullish. That is the easiest way to make sure that you're not going to get chopped up in the markets. You want to stick with what the most recent trend is doing. There are going to be days where, let's say today's candle, for instance, can go bearish, and that is fine. You're not seeking out perfection in trading. You're trying to play the probability of that at the end of the day, you're going to have more wins than losses, and you're not going to have a perfect run. You're not going to get out of trading without taking a loss. Losses are unfortunately a part of the game, and I want you guys to get used to that, because if you're scared of taking losses in trading, it's really gonna hinder your journey in trading. So get comfortable with it, see it as an expense you're paying, and focus on your next trading setup. Also, while we're on this, if you have taken a loss, forget that loss. We spoke about revenge trading. You do not want to revenge back into the market. Call it a day, start moving forward, and look at your next trade. So for that reason, that is a very simple, very easy way to determine your bias for the day. All right. Now that we've covered technical analysis, let's talk a little bit about fundamental analysis. And I don't want to bother you guys with too much of the fundamental side, because I first want you guys to get comfortable with the technical analysis side. And we will actually cover fundamental analysis in a next video. But fundamental analysis is obviously everything about the fundamentals of a company. It's talking about the EBITDA of the company. It's looking at what projections the company have coming up for the quarter or for the year. That is diving into the nitty-gritty of a company. If you think about fundamental analysis in terms of currencies and in terms of countries, now you start to look at what the various central banks are doing in terms of their monetary policy, in terms of where are the interest rates sitting at, what is the unemployment of the country, what is the net imports and exports of that country, to try and build a narrative around how well a country is doing in terms of the fundamental side of that country. So in that video, we will dive a little bit more deeper into fundamental analysis, because I believe that is a completely video on its own that requires a lot of attention and that requires a little bit more experience when it comes to fundamental analysis. All right, now you've seen what we've done on the charts. We've talked a little bit about fundamental analysis. Now we need to talk about risk management. And if you've ever heard about the holy grail of trading, for me personally, I would say that risk management is the holy grail of trading. And if your risk management is poor, you are not going to last in these markets, and your trading journey is going to be one of pain, one of debt, and one of a lot of loss. So I really want you guys to focus on the risk management side of things, and we're going to dive into a few concepts regarding risk management. So risk management separates the winners from the gamblers, and I want you guys to follow a few of these rules. So first and foremost, your risk per trade. I've talked to a lot of traders, and there's inconsistencies in terms of how much they risk per trade. For me personally, if you're trading a prop firm account, I do not suggest risking more than 0.5 to 1% of your trading capital in your prop firm account. It gives you a comfortable buffer to make some mistakes, but at no stage are you putting large amounts of money and large amounts of risk onto one trade, because you can go into that death loop where you make a loss. Now you're trying to make it back and you start to revenge trade. You want to eliminate that. You want to keep your head clear, and you want to make sure that you follow your risk plan. Stop losses. Think about it very simply. If you're driving in a car without brakes, would you feel safe going down a hill? Absolutely not. That is why stop loss orders are there to protect you. Have a stop loss in place. Don't go with a mental stop. Have a physical hard stop in place, because a lot of times you can get emotional. You can move your stops. You're going to think this market is going to turn around, and eventually you just end up in a bigger loss. So have your stop loss in place. Respect your stop loss at all costs. There's a reason you placed your stop loss there. That is the point where you are wrong in the trade. Walk away, refigure things out, and then go back to the charts. But at no stage do you ever not respect your stop loss. Risk to reward ratio is most probably one of the most widely talked about concepts, and most probably one of the most controversial concepts, because a lot of traders trade negative risk to reward. What does that mean? You're risking $100 to only make $50. And in some cases, guys that have a positive risk to reward ratio would risk $100 to potentially make $200. Now, a lot of you guys can let me know your thoughts in the comments whether you think negative risk to reward is good or whether it is bad. But personally, I do not want to suggest that there's one size fits all. But what I can say is that if you are trading negative risk to reward, the only thing is you require a very high win rate to be profitable. Where if you're trading a positive risk to reward, your win rate can be lower because your positive risk to reward makes up for the losses. So it's either a case of you've got a high win rate strategy, but your risk to reward becomes lower, or you have a very high risk to reward strategy, but your win rate becomes lower. So you have to choose what works for you. At the end of the day, there's no right or wrong. It's only a case of, are you making money at the end of the month, or are you losing money? All right, now you want to get set and take your first trade. So let's get straight into this step as well. So what I would suggest is that you register an account with our partner broker XM, and I'm going to take you through that entire step right now. All right, traders, now we're going to talk about getting your broker account, and it's very important to understand that you actually need a broker account now to physically start trading. So I'm going to ask you guys to check it out now. We're going to go through the entire process of registering your broker account. So I'm going to ask you guys to use the code in the description of this video, because we are in actual fact affiliates with XM Trading. All right, guys. So after you've clicked the link in the description of this video, it is going to take you to this page. So this is where you are going to start your registration process. Very simply put, you can put in your country of residence, you can put in your email address, you're going to put in your password, and if it asks you for a partner code, you can also put in your 2Gs trading, capital letters. That is our partner code. And then you can just say you consent. All right, so now that you have registered your account, please go and check your email. You will need to verify your account, so I'm going to do that now real quick. All right, then within your email, you will see that there's welcome to XM, verify your email. And then once you have verified your account, you will now be able to log into your trading account. Your email address is verified. All right, guys, and now you are on your broker terminal. This is where everything is going to happen. And verify now, you have to verify yourself. These are your KYC docs. These are your ID documents, as well as your proof of address. The broker needs that for compliance purposes. Here's your account. You can open up an additional account right here, but you first need to verify your profile. All right, then once you've got your account, you are going to go into the deposit section, and this is where you're actually going to choose your deposit method, and then you're going to deposit funds into your trading account. All right, after you have deposited funds into your trading account, then you can actually start trading. I'm going to give you a link on how to actually use MetaTrader 5. It's going to be somewhere on top here. Please go check it out if you are not familiar with MetaTrader 5. On this trading account, You'll also get to see your account information. If you click those three dots there, there's your account information, there's your Meta ID. The password is going to be the same password that you use to register your profile. All right, guys. Please let me know if you've got any questions. Please email support@2gs-trading.com and we will try to assist you. But this is your XM trading account and you are now ready to start trading. What I would suggest is first start off with the demo. You don't want to put yourself under pressure, risking real funds while you're still starting out. Give yourself the opportunity to make a few mistakes, and then later on, when you are comfortable, then you can start to deposit some funds into your trading account. I'm quickly going to touch on some common mistakes you will make as a beginner trader. And unfortunately, in trading, more trades does not equal more profits. This is a quality over quantity game, and that's something you might need to learn the hard way. But trust me on this, more trades do not equal more profits. The second killer of beginner traders is revenge trading. And maybe you're not a complete newbie and you would understand this, is when you take a loss, you want to jump straight back into the market to try and recover that loss, because now you want to take revenge on the markets. Please do not do it. You're going to get stuck in that death loop where you're going to continuously lose, try and revenge, lose, try again, lose. Please, no revenge trading. Stick to your plan and stick to your guns. And then the last one, last but not least, the trend is your friend till it ends. You might have heard this quite a number of times, but stick to the trend. The trend is really there to assist you. And if you go with the flow of the market, you might end up being on the right side. But trying to go against the major trend is going to end in tears, and it's going to end in loss for you. So stick to the trend. Don't fight the trend, please, guys. Starting to get to the end here, and I want to talk about your trading plan, and we're going to talk about the elements that you require to develop your own trading plan. First, you want to look at your goals, what it is that you want to achieve with your trading. Maybe you want to make an extra buck to pay for some utility bills at home. Maybe you want to make an extra buck to buy that watch. Maybe you want to make some extra money for your child's tuition for university. But whatever it is, have a set goal and make sure that it's clearly visible for you to see every single day. Is it either income or growth? For me personally, I trade and I've got my stock portfolio, and different rules apply to that. My trading does not interfere with my investing, and my strategy with my trading is different to my strategy with my investing. So you got to decide what it is that you want to do, income or growth. Very important, strategy. You have to decide on your strategy. Are you going to be a scalper? Are you going to be a swing trader? Are you going to be an investor? Please make sure that you do not strategy up. It is very easy for you as a new trader to go onto Instagram. You see all of these flashy cars, the watches, the lifestyle. You see this guy doing X, you see this guy doing Y, and all of a sudden you find yourself strategy hopping 1 week to the next. Please make sure that you find yourself a reputable mentor and stick with one strategy. You cannot refine, you cannot improve if you're constantly changing your strategy every single week. Risk rules, again, this falls into risk management. With your trading plan, you got to make sure that you clearly define your risk in terms of risk per trade, in terms of your trade management. At what stage do you get out of the trade? At what stage is the trade not valid anymore? Make sure that risk is of utmost importance to you, because ultimately as traders, we are more risk managers than we are money managers, because effectively if your risk management is good, you will be able to stick around for when the profits do eventually come. Journaling, this is most probably the thing that none of the new traders do, because it takes additional work and it's not fun. but journal your trades. I've shown so many times on stream how to journal your trades. In 5 weeks time, 6 weeks time, you can't remember what you did 6 weeks ago on the charts, but if you journal it, very simply put, take a screenshot of your trade, put some notes there. How did you feel taking the trade? Why did you take the trade? How did you manage the trade? Why did you get out of the trade? Everything that went through your mind during that trade, put that on the chart, screenshot it, save it into a journaling folder on your PC, and after the week's trading or even after the month's trading, take some time, go through the trades, and you might find that some of your losses have some type of correlation. It's either a certain time of day where you're taking losses, or your trade management is not good, and you can start to refine and improve your trading. Ultimately, you cannot improve that which you cannot measure, and make sure that you journal. This is most probably one of the most important steps as a new trader, is to journal your trades. Tools and resources. We're going to talk a little bit about what are the tools available, what are some of the resources available out there for you to further your knowledge and to further your education. One thing I do need to note is that you do not want to fill your mind with a lot of different aspects of trading. Some of you might not be new to trading, but you need to unlearn some of the content that you have consumed in your trading. So I would rather suggest keeping it simple, making sure that whatever you consume fits into your trading plan, into your trading strategy. Don't look all abroad. Don't try and be everything at once. Rather stick to one simple concept, one simple strategy, and keep it as easy as possible for you. Charting tools most widely used is TradingView. So if you have not done TradingView yet, or you don't know how to use TradingView, I'm actually going to drop a link on the top of my screen where we actually did a video on how to use TradingView. Go check that out, come back to the video, and we will see you on the next section. Education. We've got a lot of educational content on our channel. We live stream Monday to Friday, London and New York session. Free education for you guys every single day. Come and join us. Hit that like button, subscribe, hit that bell notification, and you will be reminded of when we stream every single day. So come and check it out. Also, in terms of education, we have got a membership called Project G, and you can check it out in the link of this video, in the description of this video. Project G, where we also have a big educational library that's going to take you through all of the major concepts that you would require to take your trading to the next step. Trading psychology, guys, this is most probably the thing that the majority of you will struggle with. It's easy to learn concepts, it's easy to consume content, it's easy to read books, but the big battle is in here, the psychology of a trader. And there's only really two aspects to the psychology of a trader, and that is fear and greed. These are the two monsters that we fight every single day as traders. A lot of you will be on the fear side, where you're so scared of losing money that that dominates your thoughts when you are trading. And then on the other side is greed, where you do not know when to stop. You're up on the day, you've made some money. Instead of calling it a day, you jump straight back into the market, and now you want to try and make some more. So please, this is something that might take you more time than the actual technical analysis and fundamental analysis, but getting to know yourself in terms of your own psychology and how to manage your own emotions. Now, getting into the final part of this video, I'm going to give you some final tips and tricks that you need to take to your trading desk. First and foremost, start small. Don't pressure yourself. Keep it low risk at the start. The money will come if you stick to your plan, if you stick to the course, but start small. Do not go big at the start. Consistency beats luck every single day. Stay consistent. Stay consistent with the times you trade. Stay consistent with the lot sizes you trade. Stay consistent with your strategy. Consistency in trading is what's going to make you either win or lose. consistency is key. Never stop learning, but again, do not consume things that are going to confuse you. Make sure that you keep it simple. Make sure that whatever you're learning attributes to what you are currently doing, and don't build too many layers into your trading. Some of you guys are like a big onion. There's way too many layers for you, and you get into analysis paralysis where you can't even analyze a chart or execute a trade. So keep the layers simple, but make sure those layers are effective in your trading. Thank you so much for watching, guys. Please note that this is not financial advice. Please chat to your financial advisor before making any financial decision. Trading, you can occur or incur a lot of losses. You can lose all of your trading capital. But I want to thank you guys so much for watching this video. Hit that like button, subscribe if you enjoyed the video. Thank you for watching, and we will see you guys on the next one. Peace and love, baby.